Imagine waking up tomorrow and checking your investment account, only to find that the numbers you once trusted have plummeted overnight. Your retirement plan, the money you've been saving for years, investments, suddenly seems uncertain. This isn't a nightmare. It's the harsh reality investors face during a massive stock market bubble. And right now, every indicator, every headline, and every expert warning is signaling that we are on the brink of one of the largest bubbles in history. Bubbles are dangerous because they lure you in with the promise of easy money. They make even the most disciplined investors question their strategies, encouraging risky bets on overvalued stocks, cryptocurrencies, or other assets. Investment. But the real shock isn't just the sudden collapse. It's how quietly it builds, how it disguises itself as normal market growth. Most people ignore warning signs because they're busy chasing trends. Investment. Influenced by hype on social media or sensational headlines, they believe this time is different, that the rules of economics don't apply to them. History tells us otherwise. The dot-com bubble, the 2008 financial crisis, and countless others all started with the same pattern: overconfidence, inflated valuations, and mass speculation. This speech will break down the bubble that's forming right now. It's a good investment, why it's different from anything we've seen before, and most importantly, how to protect your money before it's too late. By the end, you'll understand the exact signs to watch, the common mistakes that could cost you everything, and the strategies smart investors use to navigate dangerous markets without losing sleep or savings. If you ignore these warnings, you could be next in line for a financial shock that feels unstoppable. But if you pay attention, learn, and act wisely, you can not only survive the bubble, but potentially benefit from it. Now, a good investment. Let's dive into the 4 key points that reveal the truth behind this stock market bubble. ChatGPT said, one of the most dangerous signs of a stock market bubble is the widening gap between stock prices and the actual value of the companies behind them. In a healthy market, prices are closely linked to fundamentals, things like earnings, revenue growth, cash flow, and long-term business potential. But during a bubble, this connection weakens dramatically. Investors start to focus more on hype and less on reality, driving prices to unsustainable levels. You might see companies with minimal revenue or even consistent losses being valued in the billions simply because everyone believes the next big surge is just around the corner. This disconnect between valuation and reality is a ticking time bomb for anyone invested in the market without recognizing it. Investment. The psychology behind this phenomenon is what makes it so compelling and dangerous at the same time. When investors witness others making enormous gains seemingly overnight, the fear of missing out, or FOMO, kicks in. It's a powerful emotion that overrides rational thinking, causing even disciplined investors to question their strategies and make risky decisions. People convince themselves that the market is different this time, that traditional valuation metrics no longer apply, and that the potential reward outweighs the risk. History, however, tells a different story. Every major bubble, from the dot-com crash in the early 2000s to the housing crisis in 2008, followed a similar pattern of overvalued assets fueled by mass optimism. Another factor that amplifies the problem is the media and social environment surrounding investments. When stories of massive gains dominate headlines, investment, or when social media influencers talk about the next big stock, ordinary investors are drawn in without fully understanding the risks. The narrative of easy money creates a false sense of security. Instead of asking tough questions like, is this company profitable? Or can this growth be sustained? Investors rely on crowd sentiment to guide their decisions. Investment. The result is a market where price movements are no longer dictated by business performance, but by speculation and collective enthusiasm. This type of market behavior is particularly dangerous because it lulls investors into complacency. The higher stock prices rise, the more confident people become, often ignoring basic signs of overvaluation. They rationalize the growth by pointing to small earnings improvements, optimistic projections, or new product launches without considering the bigger picture. In reality, when valuations become detached from reality, any negative news, no matter how minor, can trigger a massive correction. The higher the prices climb, the greater the potential fall. Investment. Understanding this disconnect is crucial for anyone who wants to protect their money. Recognizing that price surges aren't always a reflection of real value allows investors to approach the market more cautiously. It encourages careful analysis, patience, and discipline, which are key to surviving periods of market instability. By focusing on the underlying fundamentals rather than chasing hype, Investors can avoid the emotional traps that lead to panic selling or catastrophic losses. In a bubble, mental knowledge and vigilance are the most powerful tools you have to navigate the storm and emerge financially intact. Speculation is the lifeblood of a stock market bubble. And it's what separates rational investing from reckless behavior. During a bubble, people stop buying stocks because of their underlying value or earnings potential and instead start purchasing them based on hype, rumors, or the expectation that someone else will pay even more tomorrow. This speculative mindset creates a self-reinforcing cycle. The more people invest without analyzing fundamentals, the higher the prices go, which attracts even more investors chasing the trend. What begins as cautious optimism quickly transforms into a frenzy, and ordinary investors, thinking they're participating in legitimate growth, often become the primary drivers of market instability. The role of herd mentality cannot be overstated. Humans are social creatures, and we naturally tend to follow the crowd, especially when money is involved. It makes a good investment. When you see everyone around you making extraordinary gains, it's hard not to jump in, even if you haven't done the proper research. This collective behavior can lead to inflated valuations in sectors that may have little to no long-term potential. Technology, cryptocurrency, meme stocks. Any area that captures public imagination can become a bubble because herd mentality encourages people to act based on what others are doing rather than what makes financial sense. Social media, news outlets, and online forums amplify speculation further. Platforms where investors share tips, discuss trends, or hype a hot stock can create the illusion that opportunities are limitless. People begin to equate attention and popularity with financial soundness. A stock that's trending on social media suddenly seems like a guaranteed winner, regardless of its financial statements. This environment can make ordinary investors feel pressure to act quickly or risk missing out, which is exactly what the bubble thrives on. The danger of speculation is that it masks risk. When decisions are driven by emotion, fear of missing out, and social proof rather than careful analysis, investors often ignore red flags. High debt levels, inconsistent earnings, investment, or unsustainable business models are overlooked because the market's excitement creates a sense of invincibility. Yet, history repeatedly proves that speculation cannot support market prices indefinitely. When sentiment shifts, the same herd mentality that pushed prices higher can accelerate the downfall, causing panic selling and massive losses. Understanding the psychology of speculation and herd behavior is critical for any investor who wants to avoid getting trapped. It's not about avoiding risk entirely, but about recognizing when market behavior is driven by emotion rather than fundamentals. By stepping back, analyzing companies carefully, and avoiding the pull of social influence, investors can make more rational decisions. Those who remain disciplined during speculative periods are often the ones who survive bubbles with their wealth intact, and sometimes even finding opportunities to profit when the frenzy collapses. In essence, speculation and herd mentality are the engines of a bubble. They create the illusion of growth, fuel unsustainable price increases, and entice even cautious investors to make poor decisions. Recognizing these patterns early and maintaining a commitment to reasoned analysis over hype is the key to staying safe and potentially benefiting when the bubble eventually bursts. Before any major stock market crash, there are warning signs, subtle patterns that often go unnoticed until it's too late. Investment. These early indicators are critical because they give investors a chance to adjust their strategies, protect their capital, and avoid panic when the bubble finally bursts. Yet, most people ignore them, and distracted by headlines, hype, and the illusion of endless growth. Recognizing these signals is one of the smartest moves an investor can make in a bubble-prone market. One of the clearest warning signs is extreme overvaluation. When stock prices reach levels that far exceed the company's actual earnings, revenue, or growth potential, it's a red flag. Price to earnings ratios soar to unsustainable heights, and price to sales ratios start looking absurd. These numbers are often brushed off during a bubble because investors are blinded by optimism and fear of missing out. But history shows that when valuations detach from reality, the market becomes extremely fragile. Any unexpected news, even minor, can trigger a massive correction, wiping out gains built over months or years. Another key signal is unusual market behavior in specific sectors. Certain industries or asset classes start attracting disproportionate attention and capital inflows, often fueled by social media trends, celebrity endorsements, or sensational headlines. For example, Investment, technology, or meme stocks may surge simply because they are popular rather than profitable. Cryptocurrencies and alternative assets can experience similar spikes. Investment. When a market segment grows faster than the overall economy without a solid foundation, it's a sign that speculation, rather than fundamentals, is driving growth. Margin debt is another critical indicator. When investors borrow heavily to buy stocks, it amplifies both upward and downward movements. Investment. High levels of margin debt create extreme vulnerability because any downturn forces investors to sell their positions to cover losses, accelerating the decline. Watching margin debt trends can give a strong clue about the market's fragility and the potential severity of a crash. Economic indicators often tell a story that contrasts sharply with soaring stock prices. If job growth slowed, corporate profits decline, or interest rates rise while the market continues to climb, it's a signal that the stock surge is not backed by the broader economy. When the underlying economy doesn't support market valuations, the risk of a bubble bursting increases exponentially. Ignoring these signs is like driving toward a cliff while staring only at the dashboard. You miss what's coming until it's too late. Finally, investor behavior itself can act as an early warning. Investment. When everyone around you is talking about getting rich quickly, chasing the next big stock, or celebrating extraordinary gains as normal, it's a clear indicator that greed is dominating the market. Smart investors pay attention to the psychology of the crowd. Excessive optimism, complacency, and mass speculation have preceded every major bubble in history. By observing both market numbers and human behavior, investment, you gain an early understanding of when a bubble is forming and when it may be time to take protective action. Recognizing these early warning signs doesn't guarantee you'll avoid losses, but it dramatically increases your odds of making informed, rational decisions. By staying vigilant, analyzing fundamentals, and keeping emotions in check, you can navigate a bubble safely and even position yourself to capitalize when the frenzy collapses. Investment. Awareness and preparation are your best defenses against the shock of a bursting market. Protecting yourself during a stock market bubble is less about trying to predict the exact moment it will burst and more about preparing your portfolio and mindset to withstand volatility. The key is discipline, strategy, and a focus on fundamentals rather than hype. One of the first steps is diversification. By spreading your investments across multiple sectors, asset classes, and geographies, you reduce the risk that a single market correction will devastate your entire portfolio. Diversification doesn't guarantee profits, but it provides a cushion against extreme losses when bubbles collapse. Maintaining a cash reserve is equally important. Having liquidity allows you to avoid panic selling during sudden market downturns and positions you to seize opportunities when prices are temporarily depressed. Investors who enter the market with cash after a bubble bursts often find themselves buying high-quality assets at a fraction of their true value. This approach requires patience, resisting the urge to invest in every trend, and understanding that sometimes the best move is to wait. Avoiding leverage is another critical principle. Borrowing money to invest can amplify gains during a bubble investment, but it can also magnify losses when the market corrects. Margin calls and forced liquidations can wipe out even experienced investors who overextend themselves. The most successful strategies during bubble periods often involve minimal debt, enabling investors to act calmly and rationally rather than being forced into decisions by external pressure. Focusing on companies with strong fundamentals is a cornerstone of a protective investment strategy. These are businesses with consistent earnings, robust cash flows, a competitive edge in their industry, and sustainable growth potential. Even if the broader market declines, companies with solid foundations are more likely to weather the storm and recover faster. By prioritizing quality over hype, investors reduce the risk of catastrophic losses and increase the likelihood of long-term wealth accumulation. Planning ahead is crucial. Set clear rules for when to buy, hold, or sell assets based on your personal risk tolerance and market conditions. Emotional decisions are often the most costly, especially during bubbles when fear and greed dominate investor behavior. Having a plan allows you to act decisively rather than react impulsively, which can prevent unnecessary losses and preserve capital. Finally, education and awareness are your strongest tools. Stay informed about market trends, economic indicators, and historical patterns. Recognize the psychological traps, FOMO, herd mentality, overconfidence that bubbles create. Investors who are aware of these risks can navigate volatility with a calm, rational approach, avoiding panic selling and positioning themselves to benefit when the market corrects. Surviving a stock market bubble isn't about timing it perfectly. It's about preparation, strategy, and self-discipline. Diversification, liquidity, avoidance of leverage, focus on fundamentals, and clear planning all contribute to maintaining control during periods of extreme market speculation. By implementing these strategies, investors not only protect their wealth, but also create opportunities to capitalize on market mispricing when others are forced to sell. Knowledge, vigilance, and a disciplined approach transform the chaos of a bubble from a threat into a chance to emerge stronger and more financially secure.